Hello and welcome to Money Matters TV. I'm your host, Doug Hepburn of Hepburn Financial Advisors, a boutique wealth management firm located in Phoenixville, Pennsylvania. I'd like to welcome my co-host today, Ken Jordan. Ken, what's new in your world?
How are you, Doug? How are you?
Doing great,
Every
thanks.
day's an exciting day in my world, Doug.
I can imagine.
Yeah.
I mean, with interest rates all over the place, I'm sure there's never a dull moment for anybody in the mortgage industry, in particular you at Princeton Mortgage.
Yeah, and we're just seeing continued interest rate pushing the higher tolerance, the higher limits, and just when you think maybe it'll stabilize, maybe it'll come back down, they push to a new high. So it's been an interesting couple of months.
Wow, and is that really supply demand driven, or is that regulatory driven, just by the Fed?
It's supply and demand driven for sure. I mean, obviously the Fed is going to set the Fed funds rate based on where they think they need to pull the levers for inflation. But the investors drive the mortgage-backed security pricing. And I think that the big issue is that investors know that if these rates are sitting at high levels, to invest their funds in a 7.5% or 7.75% book of mortgage-backed securities, there's going to be runoff when those rates start to drop and people start to refinance, which most people think is going to happen in the next 12 months. So it devalues that investment, and it causes the instruments to continue to drive up the return to the investor in order to make it attractive. 8% is attractive, 8.25% attractive, 7.5% is not. Nobody even wants them. So,
Right.
So we're continuing that supply and demand. There's very little demand for high-end mortgage-backed securities right now.
Interesting. With today's market being as tight as it is, a lot of people are probably in the position of thinking, well, I'd like to sell my house, but I don't want to sell it and be out of the house and have to live in an apartment, but I really want to buy a new house. How do you buy a new house when you haven't sold the one you're in?
It's tricky, Doug, right? Think about it. A couple of things you got to take into consideration. Do I have the money to purchase the new house without the proceeds from the sale? That's number
Right.
one. And number two, can I qualify carrying both mortgage payments for a period of time if necessary? If my house is not sold and I have to carry both of those mortgage payments, what's that going to look like? Assuming you have the money and you're able to, use at least put some money down on the new purchase, assuming you can afford to carry the mortgage on both properties, there's a couple things you can do. One is called a recast. So let's say you're getting ready to buy a house and you have 5% to put down, but you got $100,000, $200,000 in equity in the house you're selling. Well, you can use the 5% to get into the loan. And then once you sell your other house, you can make a big principal reduction payment on the new house and re-amortize your loan. It's not a refinance, it's called a recast. And that's a popular tool right now for a lot of folks who are looking to convert the equity in the home that they currently own into the new home, but they can't quite get the timing right.
Right. That's interesting. I mean, it sounds like a viable option, I'm sure, for those people who may not have the readily available liquid assets to go and put down on a brand new home. So that's interesting because that's one of the things that a lot of people are concerned about. You're selling a house because it's going appreciated in value, but you're buying a new home that's already appreciated in value. The question is, it's really got to pay to make that transaction work. I mean, there's got to be a lot of positives driving it, certainly more positives than negatives to drive that. So to be able to recast that loan, I think sounds like it could be a viable option for some people.
Yeah, I mean, you could also, the reality is you're probably going to be refinancing that loan in the next 12 months. I mean, nobody's got a crystal ball. There's certainly, risk there, but most economic, thought centers expect that interest rates are going to come down as inflationary pressures, subside. But, what are you seeing as far as the inflationary pressures out there, and how is it impacting the other the other markets?
Well, it seems like the Fed has signaled that they're willing to raise interest rates again, but they've sort of paused, if you will, last month. So the battle against inflation is still on. We saw the rapid increase in interest rates have a significant impact on economic expectations. Meaning a lot of people were expecting we're experiencing the most anticipated recession that's never happened, because everybody keeps talking about recession being right around the corner, especially when the markets tank, because markets have been a forward leading economic indicator, and we saw that happen last year. Now, that said, we've seen markets bounce back a bit. Now, a big part of that has to do with the fact that, technology is constantly evolving. And one of the things that a lot of people were curious about in the last 6 to 12 months has been artificial intelligence. I mean, I hear everybody talking about that and how that's going to, redefine our work and the work landscape, how things get done, create efficiencies. And it sounds great, but until it's here, we don't know. But in the meantime, as a forward discounting mechanism, the markets have actually seen a lot of interest in companies that chip manufacturers in particular that can handle the increased computing power required by artificial intelligence and AI programs. So that's been a significant driver of the past 6 months, and certainly the run up that we saw in the first half of this year. Whether or not that continues is anybody's guess. It's anybody's guess.
And recession that never happened. Is that what you said?
Yes. Yeah, the most anticipated recession that's never happened.
Yes.
Yeah. Well, I mean, we say that, but there's still people who have been impacted economically, and
Sure.
in the past 12 to 24 months, and that's never good for anybody. Nobody likes to see that, but unfortunately, it happens every day. And in fact, we actually got a question from one of our viewers here, Robert Hill of Ardmore asks, what are some ideas to prevent foreclosure on my home?
Well, Robert, I mean, if you think about it, it kind of ties in with what we're talking about here. Recession, does actually show up. I think one of the big drivers is going to be unemployment, and that's usually what triggers foreclosures. Usually is the loss of a primary wage earner or the loss of employment. The most important thing you could do is communicate with your lender. It's expensive for mortgage companies to foreclose on properties, and if there's equity in the property, then you have a vested interest in making sure that the bank doesn't just come and take it. So they all have loss mitigation departments that you can call, and you can work with them to make sure that you can get on to some sort of a payment plan or modification if need be. Typically, they're looking for a hardship, and you have to apply for and show what your hardship is, and they'll work with you. But if you have a lot of equity in your house, you maybe selling the house is an option. Kind of maybe take a step back and rent and re-enter the housing market is another way, but you never want to let that equity disappear on you. But like I said, as far as avoiding foreclosure, make sure that you're in open communication with your lender. That's the most important thing you can do.
I think that's great advice, Ken, for anybody out there who's in that situation. If you have questions for Money Matters TV, here's how you can get them answered.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
With advances in technology surrounding us every day, it's easy to lose the forest through the trees. The most recent development, which we just talked about, was artificial intelligence and how that appears to be something on the horizon, actually right here, that may change our work lives significantly. But prior to that, the big technological innovation that we saw was blockchain technology, which has the potential to revolutionize virtually any industry that touches accounting or finance or record keeping. With that, I'd like to introduce our guest today, Isaac Patka, co-founder of Shield3.com, which is using artificial intelligence to help businesses secure their blockchain transactions. Hello, Isaac, and welcome to Money Matters.
Hi, thanks for having me.
Oh, glad you could join us. So tell us about Shield3 and what inspired you to start the company.
Sure. So we offer a simple drop-in compliance and security automation tool for basically anybody that does crypto transactions. Transacting on blockchain is very complex, and the burden is very high on anybody that's using it to understand what they're doing, understanding what they're interacting with. But there's a big opportunity to automate away a lot of that complexity and make it easier, more approachable, and more accessible. And that's what we offer.
Isaac, the burden is on us to understand, right? The burden is on those that get into blockchain to understand. But I know that there's a fair amount of people that still don't really understand it. So if you could just, what is blockchain and why is it so important?
Sure. So blockchain technology creates a global distributed financial network that's not controlled by any one party. Basically, anybody can connect to this network and transact, similar to how anybody can log into the internet. The simplest way to think about it is like an internet for money, where instead of data and blog sites and stores, there's actual financial transactions happening, and anybody can use it. Doesn't matter where you are in the world. And that's important for a lot of cases where financial services are restricted based on where you live, are restricted based on what the government regulations are where you live. And by creating these global networks that aren't controlled by single parties, we can get around some of the issues and that we've seen in the past with the traditional financial system.
That's great. And just to clarify, my understanding is that blockchain is really like a distributed ledger, meaning, you've got all these different computers or sites around the world that have a record of almost an accounting record of who owns what. And so with that distributed ledger technology, I would think that a lot of accountants might be concerned. How does that impact large businesses?
Sure. Large businesses, I think, are starting to actually see the optimizations and the efficiency improvements that they could gain from adopting technology like this. I mean, for myself, I run a company and we work with contractors and employees around the world, and it is just it's so far more efficient to pay everybody that we work with using cryptocurrency, because they can then off-ramp that to whatever bank they need to do to pay whatever local bills they have to pay. But it's at least in my sphere, which I know is different than most. It's just become a major efficiency gain, and a lot of large companies are starting to experiment with leveraging that to reduce the amount of manual labor and manual work that goes into processing, validating transactions, keeping accounting records, checking the books, all of those processes.
It's just to add to that, it's my understanding that as many as 50 of the Fortune 100 companies, if not more, are using blockchain currently, including the largest retailers and some product manufacturers, including financial institutions. So that's kind of interesting to see that the blockchain is being adopted at such a high level.
That's right. And it's not just the native cryptocurrencies. And when I say native cryptocurrencies, these are the ones that people have heard of. But
Right.
there's other ways of using the blockchain technology that's not just transacting in these like entirely new currencies. There's a
Right.
lot of experimentation happening in the what people are calling the real world asset space, which is where people are creating tokenized representations of real assets and putting them on the blockchain to do all sorts of things, whether it's tracking provenance and ownership, or even just creating different ways of for brands to interact with their communities and followers.
How does blockchain impact? We talked about big companies. How does it impact everyday consumers?
Sure. It highly depends, honestly, on where you live. So for a lot of the folks that I meet with day to day or go out to lunch with, we're not like paying each other back for lunch using cryptocurrencies. Like a lot of the traditional financial tools are sufficient in this country, in the U.S. where we live. But when I go to conferences and when I work with people that live in lots of different countries, especially many in South America, for them it's become the way that they get paid, the way that they save, the way that they transact and get employment. So I'd say it's highly dependent. For people in the U.S., we probably won't ever see a day where, like, instead of pulling cash out of your wallet, you're like opening up some like your crypto ledger. Instead, it's probably going to be integrated more behind the scenes. So the banks that you're using, the credit cards that you're using, it's very possible that those transactions will soon be settled on some sort of ledger, but it doesn't have to be too visible. And the invisible aspect is actually quite important, because I think one of the main problems of the cryptocurrency space is that we expect every consumer who comes on to become an expert in cryptography and wallets and storing things and all of those complexities that they have to do. I think that's just too much of a burden. As much as we can put it into the background and make it just an efficiency gain, I think that'll be quite important for people to actually start to see some value from it.
So are consumers really saving money by using cryptocurrency for transactions?
In some cases, yes. In some cases, no. Like the interesting thing about how fees work on the blockchain is it's all like demand based for how much the transaction fee is going to cost. So if like on a crowded highway or anywhere where we're seeing higher traffic, fees go up with however many people are wanting to transact. So if there's some sort of like big event happening that's causing a large spike in transactions, just to send $1 from me to you might cost me $20, $30 in fees. Versus if I'm like up in the middle of the night and nobody else is using the blockchain, it can cost like just cents. And the fees, of course, depend on which blockchain you're using. So for average consumers, for average transactions, it's probably not cheaper than using a credit card, than using a peer-to-peer payment app that people are used to. However, when you're doing larger transactions or cross-border transactions, often the fees can be so much lower, and the transactions are much faster. So it depends on who you're transacting with. What's funny is, like, over the past few years, when I've had various things I've had to do, like I'm a smart contract developer, and you have to put that code out there on the blockchain, which costs a lot of fees. Sometimes I'll like set my alarm to wake up at 2 a.m. when no one else is using the blockchain, so that I can do it for 10, 20, 100 times lower cost.
Interesting. So are there risks? And if there are, what are the risks of crypto and with regard to everyday consumers?
Sure. One of the main risks is around how custody works. I'd say similar to how if you like drop your wallet and lose your cash, there's no like helpline available to like get your cash back. There's no helpline available if you for some reason lose your crypto assets. And so the user experience around securing them is quite hard. Actually, okay, I have like a prop at my desk. Like, it's kind of funny. Like, these are these like metal plates. There's nothing on here, of course, that a lot of people in this space use to like hammer their like passwords into to store their assets, and then they'll do something like put it in a safe. So it's like you're using this like crazy high tech ledger, and yet you're still like putting a metal plate in a safe to store your assets. That, of course, is not exactly something we can expect every consumer to do. So there's lots of other options that people have for ways of backing things up. But a lot of the ways that people end up losing their coins is by backing up their codes in insecure ways. If they put it on a note on their computer, or a sticky note on their desk, or as like a note in their email drafts, like these are all places where if you lose a password, someone can find it. And there's a very sophisticated network of bots out there that are just looking on the internet for anybody that might have accidentally like typed in their key on Facebook or somewhere to scrape and immediately take all those funds.
Wow. So how does Shield 3 fit into the blockchain and digital currency space?
Sure. So we do a few things. One is we offer a product suite to any company that's doing blockchain transactions to just monitor everything that they're doing, broadcast any transaction that they were going to do, goes through a proxy that we run, and it makes sure that they're not facilitating anything like fraud or violating any sort of government regulations, and it automates all of the headaches that that they have to deal with by being a normal company that's also transacting on blockchain. And then beyond that, for consumers and for other companies, we do a lot of exercises just to build the resiliency of the space. The cryptocurrency space is far less mature than the traditional finance space. There's a term called like white hat hacking, which basically means that you use the same types of tools that a malicious individual would use to try to steal funds, and you instead use those same tools to try to rescue and save funds and protect people. And so one of the things that we actually do is we work with crypto native companies in this space and put them through all sorts of like simulations and attacks and things that they will face in the future to get them ready to make sure that they are able to, one, protect their own assets and protect the assets of the consumers that they're serving.
Interesting.
So I have a question, though, it's okay. So many people are worried about a central bank digital currency. Is that really something we should be worried about?
I think it's inevitable that governments will try to enter this market. In fact, many already are. Like we were talking about the efficiency gains of having programmable digital money. It's hard to ignore that as something more efficient than a lot of our current systems. And what I think governments are worried about is kind of losing the sovereignty, losing the position of authority when it comes to issuing money, setting supplies, setting rates, all of that. I think that as cryptocurrency continues to gain adoption, we'll see a lot of governments start to create these things. And the main risk I think that people are concerned about, and I have the same concerns, is like what happens when every transaction that you're doing becomes like completely open and available to the public. Transactions on blockchain are actually much less private than traditional transactions that people are used to. So if there is a central bank digital currency that comes, I think it will be quite important for people to push for some sort of privacy controls to be in place, because if not, I could definitely see a future where people can face discrimination based on who they've transacted with in the past, what charities they've donated to, where they're getting employment. If all of that becomes publicly auditable and transparent to everybody, then through a central bank digital currency, I'd be concerned about what sort of additional like pressures we might face from that lack of privacy.
Man, with all those risks, what are the benefits? Why would anybody really, want to dive into this? When you've got, your volatility risk, you've got the whole, glossary of terms that you have to learn and things you have to understand in order to be able to transact in this world. And then of course, you've got the threat of government control. Obviously, the government in general wants as much control as they can get. and it's only ceded to them by the citizens. So by citizens participating in this, they're actually ceding control to the government at some point on some level. Why would anybody want to do that?
So there's a couple things for me as as a developer, the opportunity to build applications that can program money the way that other applications can program information is just a very attractive space to play in. There's a large part of the cryptocurrency space that is experimenting with different types of economic models, different types of compensation models, different ways of funding public goods, public resources, charities, local communities. There are many different ways that we can approach how money is issued, how interest rates work, how all of that happens. And the cryptocurrency space provides a layer on which we can experiment and do and figure out what works and what doesn't. And I think we'll find that there will be more sophisticated, more interesting, and more fair types of economic systems that can develop through this like rapid evolution and rapid iteration. That is like one of the most attractive things to me. And if people are interested in those types of experiments, I mean, those are some of the most fun communities to be in within the space. And then other than that, I could not see my company going back to just doing wire transfers all the time to all the people that we have to work with around the world. So I couldn't go back to the world of without this efficiency. And I think that I'm excited, and I think others would be excited about the amount of experimentation that we can do to try to change how our economies are structured and figure out if there's better systems, fairer systems for everyone involved.
Well, this has been a fascinating discussion because it is such a cutting edge topic, and certainly we appreciate your time, Isaac, and the work that your company's doing. In the meantime, we appreciate all you viewers for tuning in to Money Matters TV. This has been a great show, and stay tuned for next week's show where we have Jim Hemphill, CFP of TGS Financial Advisors. And as always, we love it when you tune in to Money Matters, because this is one place where your money matters.